$500 billion. That's how much money U.S. banks had to borrow from Federal Home Loan banks during the month of March. What's up, guys? I'm Nobody Special. And while all the attention over the last few weeks has been paid to things like the Federal Reserve's new Bank Term Funding Program or the discount window, where a lot of banks were scrambling for liquidity at the last minute during the bank run last month, it appears that the majority of that borrowing was actually happening at Federal Home Loan banks. And now that the dust is settled from the failure of Silicon Valley Bank and the ensuing chaos in the financial system, we're starting to see just how close the system came last month. Check out this one dated just yesterday in the Wall Street Journal. Banks leaned on a little-known lender in March as customers fled. Silicon Valley Bank and Signature Bank borrowed heavily from Federal Home Loan banks before collapsing. Banks are turning to an obscure government-linked lender to shore up their balance sheets following the industry's rockiest period in years. The Federal Home Loan Bank system, established during the Great Depression to help promote mortgage lending and now a source of liquidity for banks of all stripes, issued a record $495 billion of debt in March to fund loans, which are called advances, the system's Office of Finance said. Banks ramped up borrowing that month as customers pulled out deposits and investors panicked over failures that threw the stability of the U.S. financial system into question. So while all this attention was being paid to the Fed discount window and to the new Bank Term Funding Program and the $30 billion rescue of First Republic Bank, $495 billion, nearly $500 billion, was being borrowed by banks all over the country from the Federal Home Loan banks. Now, these FHLBs are known as the lender of second to last resort. It's basically a bank for banks, and it's supposed to be the last place banks can go for money before they get to the Fed. And boy, did they ever last month, $495 billion. That is a record amount of lending in just 1 month in March. Charles Schwab, a brokerage firm whose bank operations experienced significant withdrawals on Monday, disclosed that it had borrowed $46 billion in FHLB advances in the first quarter. That's up from $12 billion in the prior quarter and $0 a year earlier. Other banks are also expected to disclose their advances in the coming weeks. The 11 government-sponsored home loan banks have drawn scrutiny in recent weeks because Silicon Valley Bank, Signature Bank, and Silvergate Capital Corp borrowed billions from them. Those banks all went out of business in March in a stunning series of collapses, and critics say that the home loan banks have gone beyond their mission of supporting housing and that the closures show they sometimes prop up banks that aren't stable. You think? Now, one thing to note is that this is not cheap debt. This is actually pretty expensive debt, and the article goes into some detail about this. Still, the money is more expensive for banks than consumer deposits. The current rates on FHLB advances are generally between 4 and 5%. But the typical savings account pays about 0.37% according to the FDIC. Schwab said that the higher cost funding from the FHLB would hit revenue and profits. These are limited and they're temporary, Chief Financial Officer Peter Crawford said of the brokerage's advances. This is not something that's going to be part of our long-term financial picture, and we will certainly pay them off as quickly as we can. Now, the problem is going into this crisis at the beginning of March, lending was already near an all-time high with the FHLB. FHLB advances to banks reached a post-financial crisis record of about $820 billion at the end of 2022, according to the Federal Reserve and FHLB data. SVB, Silvergate, and First Republic Bank, which got a $30 billion deposit infusion from the biggest U.S. banks last month as it faced fleeing customers, were among the top borrowers at the San Francisco FHLB at the end of 2022. So you can see here, folks, that borrowing from the Federal Home Loan banks is usually a sign of distress from these banks. When you see a bank leaning heavily on the FHLB, it means they're desperate for liquidity, even if it means paying 4% or 5% interest in order to get it. Right now, there are more people lining up at the FHLB for cash than at any point in history. Cornelius Hurley, a Boston University law professor and a former director of the FHLB of Boston, said the fact that Silicon Valley Bank, Signature, and Silvergate all ramped up borrowing from FHLBs last year should have been a sign that they were in trouble. Those are banks that they lent liberally to when perhaps they should not have, he said. Other banks say they borrow in the course of doing business. John Rigler II, chairman and CEO of a Clive, Iowa-based People's Bank, which has $447 million in assets, said his bank borrows from the Des Moines FHLB on a regular basis. So not everybody who borrows from the Fed Home Loan banks is desperate and about to go out of business, apparently, but still, when you see a big spike in borrowing from the FHLB, that usually means something bad is on the horizon. The home loan banks have assumed an important role over the past 2 decades. Loan volume surged in 2007 in the run-up to the financial crisis, and Countrywide and IndyMac borrowed from the home loan bank system before collapsing as the crisis unfolded. So again, you see people running to the FHLB for liquidity. It's usually a precursor to something bad happening, because in order to pay 4 or 5% for liquidity, it means these banks are already desperate. And how desperate? Well, check this out. The week after Silicon Valley Bank and Signature failed, the FHLB system issued $304 billion of debt, suggesting a run-up in demand for advances. That's mildly put. $304 billion had to be loaned into existence by the FHLB in just the 1 week after the crisis. And for the month of March as a whole, it was $495 billion total. Now, as you can see here in this chart, a sudden run-up in FHLB advances is usually a precursor to some very bad things about to happen in the financial system. Look no further than the third quarter of 2007, right as the GFC was really getting underway. We saw a massive spike right there in Q3 borrowing from the FHLBs, and that would continue to peak at about $1 trillion at the end of Q3 of 2008, before the Federal Reserve opened the floodgates of liquidity and eventually that borrowing subsided. And then we saw something similar in the first quarter of 2020 leading up to the pandemic, a big sudden surge in borrowing in the first quarter of 2020. But I want to zoom in all the way over there at the last couple of quarters, starting at the end of 2021. Now you can see here the low on this chart was the third quarter of 2021 at $344 billion of borrowing, and that chart began to very slowly tick up at first in the fourth quarter of 2021 at $346 billion in borrowing. And what was in the fourth quarter of 2021? Well, in November of 2021, you might recall, that was the infamous Fed taper, when they began to slowly reduce their purchases of assets, reduce their quantitative easing. They started printing less money starting in November. And you can see, as soon as the Fed started shutting off the fire hose, just a little bit, the borrowing started to pick up at the FHLB. The banks went looking for their liquidity elsewhere, and of course they found it. That would go on to get worse in the first quarter of 2022. And then, of course, when QT started, when quantitative tightening or the destruction of money at the Fed started, you can see that the borrowing started to spike at the FHLB, and it didn't stop all year, ending in Q4 of 2022 at $823.9 billion borrowed from federal home loan banks. Now, that's just the latest number available at the end of 2022. That shows us $823.9 billion. We have to add to that at least the $495 billion that was borrowed just in the month of March, plus as a good bet they borrowed even more in January and February. So if you add those numbers to this $823 billion, right now borrowing from the FHLB is by far an all-time high, eclipsing even the $1 trillion that was borrowed at the height of the GFC. Our banks are getting desperate for liquidity, and they're getting it anywhere they can. And remember, the FHLB is not the only place the banks are turning for liquidity. They're also getting it from the Fed's discount window and from the new bank term funding program. You can see here these numbers from March. There was an awful lot of borrowing going on from those programs also, although clearly the trend is coming down a little bit in the weeks after, but still well in excess of $125 billion being borrowed from the Fed discount window and the BTFP. So long story short, while we were being reassured over and over again how strong and resilient our financial system was last month, the numbers sing a different tune. Our banks were desperate for liquidity last month. They were lined up anywhere they could borrow it, borrowing over $150 billion from the Fed's discount window and the bank term funding program, and nearly $500 billion from the federal home loan banks. And now it appears that borrowings from the FHLB have eclipsed even the height of the global financial crisis. And things are still getting worse, folks. Deposits are still being pulled out of these banks and flowing into money markets, and the Fed is planning on yet another rate hike, let alone the fact that quantitative tightening is also still happening. So when you look at this whole picture in context, it's not looking like March was the banking crisis. March was just the banking crisis before the banking crisis, and the big one is still ahead of us. Till next time, live small and dream big.